Every year, corporate fraud survives long enough to pass audits, clear committees, and get signed off by boards that are legally required to oversee the systems meant to stop it. If you're a CFO certifying financials, an audit committee chair approving statements, or an independent director signing off on governance, you're operating on the assumption that your audit committee briefing equals board-level oversight. They didn't miss the fraud. They missed their job. A major audit regulator just documented this failure mode in completed misconduct investigations, and the U.S. regulatory architecture has the same exposure built into PCAOB standards and SOX requirements. So which governance layer actually failed? And why does this keep happening? Audit committees were reshaped by the Sarbanes-Oxley Act, Section 301, to strengthen independent oversight of financial reporting and auditor communications. The design intent, independence, escalation pathways, and direct auditor access without management filtering. This isn't best practice guidance. For U.S.-listed companies, it's a legal governance requirement. In practice, audit committees function as information filters, not conduits. Issues get summarized, contextualized, softened, and packaged before reaching full boards. The board receives conclusions and recommendations, not raw fraud warnings or unresolved control deficiencies. Here's the pattern. Audit committees don't escalate risk, they manage it. In many organizations, there is no routine requirement that every unresolved audit warning reach the full board in primary form. Audit committees can close loops internally, resolve issues with management, and report only outcomes to the board. This creates process without oversight. Forms are filed, meetings are held, minutes are taken, but boards never see primary evidence. This is absorption. Containment, buffering. Regulators evaluate outcomes, not intentions. When corporate fraud survives governance layers, liability migrates upward. Boards don't get credit for not knowing when the information existed inside the audit committee loop. And that gap between intent and practice is exactly where corporate fraud survives. NFRA released a circular on January 7, 2026, highlighting audit failures termed governance failures based on investigations of professional misconduct. This isn't theoretical risk assessment, this is enforcement documentation from completed misconduct cases. NFRA is India's primary audit regulator with statutory investigation authority. Finding number 1, auditors repeatedly misidentified those charged with governance. NFRA found auditors treating audit committees, or even management, as those charged with governance instead of the board of directors. When auditors treat the audit committee as the governance endpoint, the board never becomes aware of unresolved fraud risks. Finding number 2, communication architecture failure. Communication with those charged with governance was incomplete and inadequately documented, with many engagements lacking evidence of two-way dialogue on significant strategic decisions, fraud-related matters, and other issues relevant to senior management and governance. In many cases, there was no documented evidence those conversations happened with the board. Auditors briefed audit committees. Audit committees briefed management. Boards received summaries of summaries. Finding number 3, systematic SA 265 failures. NFRA identified systemic breaches of SA 265, where auditors did not report serious internal control deficiencies, including absent internal controls, weak credit policies, and risk management committees that failed to meet for multiple years. Absent internal controls. No control environment documentation existed. Risk committees that failed to meet for multiple years. Governance on paper, not in practice. These deficiencies never reached board-level visibility because audit committees absorbed them. NFRA lists non-compliances such as limiting communication to a brief presentation shortly before financial statement approval, with poor documentation of discussions or follow-up actions. If you think this is an India regulatory issue that doesn't apply to U.S. companies, you're operating on the exact assumption that creates liability. PCAOB Auditing Standard 1301 requires auditors to communicate specified matters with audit committees and obtain information relevant to the audit. Sarbanes-Oxley Section 301 establishes the audit committee as a board committee with defined oversight responsibilities, not an independent governance layer. The U.S. legal structure has the same architecture. Boards delegate oversight to committees. Committees receive auditor communications. Boards receive committee summaries. Here's the false assumption NFRA findings expose. If the audit committee was briefed, governance worked. Here's the reality. Audit committees are information checkpoints, and checkpoints can become choke points. When fraud warnings stop at the audit committee level, the board cannot fulfill its oversight duty because it never received the primary information. Remember Episode 11. ADM's $40 million SEC penalty for segment-level fraud. Enforcement often focuses on the gap between committee-level awareness and board-level visibility. That's not a unique case. That's the structural outcome when committees filter instead of escalate. U.S. multinationals with Indian operations face NFRA oversight on statutory audits of Indian subsidiaries. Group audits using component auditors in multiple jurisdictions inherit communication architecture from each component. If your audit committee is relying on summaries from component audits, you're running the same bottleneck. NFRA is actively disciplining. PCAOB registered audit firms face inspection risk when AS1301 communication requirements fail. CFOs who certify financial reporting controls are accountable for disclosure controls, including whether fraud warnings can reach the board. Audit committee chairs cannot delegate board-level knowledge requirements. Independent directors face fiduciary exposure when what the board knew becomes relevant in fraud cases where detection was possible but didn't occur. The NFRA findings weren't abstract. They were specific, recurring, and operational, absent internal controls. Companies operating without documented control frameworks, and auditors never escalating this to boards. Weak credit policies. Lending or extending credit without assessment processes, and audit committees treating this as management's area. Ghost risk committees. Governance documents showing risk committees exist, but no meetings held for multiple years, and boards unaware. These aren't edge cases. These are the baseline failures that NFRA found repeatedly across misconduct investigations. Question for professionals: when was the last time your full board saw the auditor's management letter unfiltered, with time to challenge findings before signing financials? If your answer is, the audit committee handles that, you're describing the bottleneck, not refuting it. The circular stresses that audits do not dilute governance accountability. Boards remain responsible even when auditors or audit committees mishandle communication. Regulatory logic. The board's fiduciary duty doesn't decrease when delegation increases. If fraud was detectable through available information, but the board never received that information, the delegation structure becomes the liability exposure. This is executive deception by architecture, not by intent. The pattern NFRA documented governance structures designed to prevent fraud actually enabled concealment when committees absorbed warnings instead of escalating them. And this matters now because NFRA's enforcement circular signals active regulatory focus on communication architecture failures, with U.S. regulators monitoring international precedents. NFRA's circular is not generic guidance. It is a compliance warning grounded in findings from completed misconduct investigations. NFRA's circular makes clear auditors are expected to identify the board as those charged with governance, not audit committees or management. NFRA frames two-way dialogue on fraud risks as requiring documentation that evidences board-level participation. NFRA signaled that serious control deficiencies should be communicated in a way that reaches board-level governance, not just committee briefings. While NFRA operates in India, U.S. regulators, PCAOB, and the SEC can take cues from international enforcement trends on governance and audit quality. PCAOB inspections evaluate how well audit committee communications comply with the standard's requirements, including timeliness, content, and documentation. NFRA's findings offer concrete examples of communication patterns regulators may regard as ineffective. In disclosure controls cases, investigators often focus on whether decision-makers had timely access to information that would have surfaced the problem. If the answer is the audit committee had it but didn't escalate, that is unlikely to function as a defense and can be viewed as evidence of a disclosure controls failure. Audit committee chairs. Can you produce written evidence that your full board received primary auditor communications on fraud risks? CFOs. If investigators ask what your board knew about control deficiencies, can you show board-level documentation or only committee minutes? These are the questions PCAOB inspections and SEC investigations ask when fraud survives governance layers. NFRA documented what happens when audit committees become information bottlenecks. Boards approve financials without seeing the fraud warnings that existed inside the governance structure. This isn't unique to India. It's structural. And the U.S. regulatory framework has the same architecture with the same failure modes. The belief, our audit committee handles oversight, so we're covered. The failure, oversight requires visibility, and committees that filter instead of escalate eliminate visibility. The accountability boundary. Boards remain responsible for what they should have known, not just what they were told. If you're signing financials, serving on an audit committee, or certifying controls, the question isn't, did we follow process? The question is, if fraud existed, would our communication architecture have surfaced it to the board with enough time to act? NFRA's findings show that in multiple misconduct cases, the answer was no, and the governance structure was the reason. I analyze corporate fraud patterns, so you don't have to. If your audit committee is the last stop for fraud warnings, instead of a relay point to the board, you're not running governance, you're running interference. And if regulators ask why it failed, the architecture is what they'll examine first. This analysis is based on NFRA's January 7, 2026, Enforcement Circular documenting audit communication failures from completed professional misconduct investigations, cross-referenced with PCAOB Auditing Standard 1301 and Sarbanes-Oxley Section 301 requirements for U.S.-listed companies. Full sources and documentation are in the description. The governance layer that failed? The one designed to prevent exactly this.